Hey everyone, my name is Alex Blackwood, CEO and co-founder of Mogul, and with me always is.
Joey Tao, COO and co-founder of Mogul as well.
And so with that, we're going to give it a sec here until people stream in, but high level, I can go over kind of a background as to what we're going to go over in the webinar. I can give a brief introduction about myself. Joey can give a brief introduction about himself. We're going to dive into the full-on webinar format, but outside of that, I'll give an overview of the current market, and then Joey will be highlighting some of our newest assets, going through the underwriting, our investment thesis, and rationale behind those. And in addition to it, we'll have some surprises along the way. And so stay tuned for that. And it'll be an exclusive for the webinar, maybe a potential property launch live. So with that, we can dive right into it. Background on myself: coming out of school, I went to Goldman Sachs. I worked in their investment banking division. And then I moved out to their real estate private equity group where I met Joey. And in between the two roles, had a chance to purchase my first investment property. Got to thinking there's got to be a better way to do this. And so when I met Joey, I joked that he was the residential wunderkind, so to speak, at Goldman Sachs, having grown their single-family rental platform from 0 to a billion in under 12 months, 3 to 4 individuals. And so I called him, asked him to meet me in a diner after playing tennis one day, and pitched him on this crazy idea. And we've been growing it ever since about early or late 2021. So it's been an incredible journey. And so with that, Joe, if you want to give a brief background on yourself.
Yeah, absolutely. So I'd been at Goldman for about three and a half years when Alex joined the group, and as he said, we hit it off right away. I'd been focused on multifamily LP investments, mostly equity, but we were generalists by trade. And when Alex kind of approached me with the idea, it just felt like a no-brainer, and I hadn't said yes to many risky things up until that point, and it just felt like the right thing to do. So here we are.
Perfect. Well, that's a little bit of background on us. Now we can jump into everything real estate as well as the current market environment. So I'll give a brief overview of the market, and then I'll turn it over to Joey to talk through a little bit more about the assets. And if Joey wants to pipe in with any questions or help me at any time, so that way I don't have to ramble throughout it, by all means, go ahead. So obviously, the major point right now is market volatility. You're seeing swings of the Dow, the S&P 500 of hundreds of points in a day. That's mainly due to a few different factors. Number one being the tariffs and trade war that we're seeing right now. Obviously, Trump, when he first hit office, said, I'm going to impose a 25% blanket tariff across Canada and Mexico, and then an additional 10% for Chinese imports. And so with that, basically it's been this game of chicken where some countries are countering those tariffs and coming in with their own counter tariffs to our tariffs. However, at the end of the day, we haven't actually imposed those tariffs to date, and they've kept being pushed off until what is being determined the drop dead date, so to speak, of April 2nd. Don't know why they didn't choose April 1st. You had a full April Fool's Day right there where you could have backed out of it at any given time, but they chose April 2nd. And so that is when the tariffs will go into full effect. It's almost like a scarier version of matching, whereby we're going to present each and every country their quote unquote number, which is going to be their tariff. And obviously, that's a shout out to everyone that got matched over the last little bit for med school, but it's a very scary version of that. Now, outside of that, you have the Doge impact. And by that, I mean, what they're doing, they're moving at a rapid pace. You've never seen the government move this quick. And so, whether you agree with what they're doing or not, they are cutting things at a rapid pace, but then it brings up the question of legality of it all. And by that, when they cut a number of these different jobs, it's now being challenged in courts. And a number of those people that had lost their jobs might actually get the jobs back if they haven't already found other offers in the private sector. Outside of that, broader concerns around war outside the U.S., whether it be the wars in Ukraine or the Israel-Palestine war. And so wars in Ukraine, Zelensky visit obviously went off pretty explosive as it relates to foreign dignitaries entering the White House. And so I'm not even going to touch on the broader concerns around war because I think that a lot of different people have a lot of different views on each of the wars. And so I don't really want to get canceled here. Outside of that, Greenland, didn't know I really wanted Greenland until I was told that China wanted Greenland. And that's exactly how President Trump is reacting here, where they want to buy Greenland because of the natural gas and petroleum underneath, obviously, in Greenland, and that's why China wants it now. If you're looking at the interest rate cuts, which are obviously on everyone's minds, the Fed at the most recent Fed meeting held interest rates steady, and that was primarily due to a mix of stagnation and growth, but also inflation on the horizon, which leads to a event called stagflation, which is a very negative term, which basically means that things are getting exorbitantly pricier, but the growth isn't occurring in line with that. Inflation in healthy doses is good for a healthy economy. However, when you have inflation that's runaway, or in this case, it's starting to tick up, especially in the midst of these tariff talks, then mixed with the stagnated growth, you're going to see things called stagflation, which again is definitely detrimental to the economy. With all that being said, the Fed still does project at least 2 interest rate cuts by the end of the year. Again, the two things that would drive them to cut interest rates sooner are inflation going back down to the 2% level, or the labor market softening even further. And with the whole thing on the horizon of tariffs, that's exactly what we're going to see. Is they're going to wait to see it by ear, or play it by ear, so to speak. M&A is heating up, though, with the Wiz acquisition, obviously the $32 billion acquisition by Google. That's a major indicator of all signs to come in the M&A market. The Wiz deal actually fell through prior because they didn't know if they could get the approval for regulatory-wise for it to go through. Now they do think they can get that regulatory approval, so that means that it's unlocking the M&A market even further. You have the Poppy acquisition for roughly $2 billion. Walgreens was sold. Obviously, that was kind of sold for parts to a private equity firm. And outside of that, you've got Klarna that just filed for the IPO, and they made the news for trying to bolster their revenue with that Eat Now, Pay Later, DoorDash partnership. And so outside of that, the things that you need to consider, especially as you start to look at these different market events, are the risk versus return of the different asset classes that you're investing in. And so obviously, the stock market is whipping up and down by hundreds of points and a ton of percentage points each day. And so when you think about it on the long term, yes, stocks might return on average 9% a year when it comes to the S&P 500 index, if you do weighted cost dollar averaging, which again, we can get into way later on. But it's going to come with these volatile moments where it's going to dip down and dip up. It's not going to be a steady trend upwards. And so when you compare it against real estate, which is a steady trend, and it's not necessarily a massive dip overnight or a massive, obviously, increase overnight, then that's something to consider, especially when you're considering the risk versus return. Not all returns are the same. And then if you look even within an asset profile at a real estate asset, a development out in the middle of a random country, that promises a 12% return versus a stabilized asset in an up and coming area that is already yielding 8%. That 8% versus a 12% return in that development deal is going to be a lot more attractive, in my opinion, because you have to weigh that risk versus return profile. And that's here at Mogul. We focus entirely on that risk return profile and focus on the ways to maximize that risk adjusted return, so to speak. I used to hate it at Goldman, talking about risk adjusted return. Why wouldn't you just take things that are a lot more volatile? But obviously, as you're constructing a portfolio, you've really got to take into account risk, especially through the upcoming cycle, what we're going to see there. So with that, Joey, I don't know if you had any questions on it, or if there's anything you wanted to cover there.
Yeah, no, I think just, if you want to tie it all back to kind of where we're going in terms of the market, like what's your outlook on where you think you would invest your money? What does this mean, for real estate going forward? That might be a good segue into my segment as well.
Yeah, so I mean, when we focus on the way to construct your portfolio, there are two different schools of thought around portfolio allocation theory. There was the traditional 60-40 mix, 60% stock, 40% bond. And then there was this new theory that came about with the Yale CIO behind his endowment. Sorry, Joey, I know you're a Harvard guy, so that probably stung a little bit, but it became the trademark of portfolio allocation theory, meaning that they switched from a 60-40 mix to a 50-30-20 mix, 50% stock, 30% bond, 20% real estate. Now, that's what our platform allows you to do, is add 20% of a real estate portfolio to your portfolio allocation strategy. Now, the way that I'm thinking about it, especially on the onset, the stock market for me right now is way too volatile. However, in times of turmoil, that's when the most legendary investors are made. It's when they deploy with a strict regimen through the times of volatility. And so when you think about real estate, especially, a lot of volatility is happening there, but it's kind of undue concern, in my opinion. And by that, I mean interest rates are actually considering and trending downwards, especially as it relates to the 10-year Treasury, and especially as it relates to Fed fund rates. They haven't cut them, but mortgage rates have come down substantially, especially with what we're seeing at Mogul. And that's why there was a massive uptick in home sales in February. It jumped up by about 4.2% when it was supposed to have declined by about 2%. And so when you think about the real estate market on the go forward, number one, the demand is there and the supply constraints are such justified that the top line appreciation is going to continue to go upwards. Now, outside of that, if you look at the bottom line from the operational perspective, people need a place to live. Leases are going to continue to go upwards, especially as supply constraints are locked in with these quote unquote golden handcuffs. Now, all that to say, you get the benefit of the high returning, high yielding assets in addition to the appreciation on the back end. And so that's why I'm deploying a lot more in real estate. And to be honest with you, the only real estate I invest in now is completely through Mogul at this point. But obviously, that's me smoking my own supply, so to speak.
Getting high on your own supply.
Yeah, there you go. Yeah,
hey, when it's Mogul supply, it's not about supply to get high on. No, but I think that's a really good point. I think one of the things that we track as we're looking at our markets and our market selections is rent price increases, right? And you hit that the nail on the head. I mean, we use data from providers like RealPage, Axiometrics, CoStar, CBRE, and we're constantly tracking the annual rent price increase index. And effectively, people can cut that any way they want. You know, they can do Class A multifamily and homes over 500,000 only, and you can kind of cut it in many different ways to look at it. But really, we aggregate it according to our buy box every single month, and we look at exactly what the data is saying in terms of which markets are showing the strongest fundamentals from a rent increase perspective, from a value increase perspective, historical and projected going forward. So that plays a huge part in kind of how we think about our portfolio construction and how we're thinking about our risk versus return as we're constructing the portfolios across different markets, across different segments of the markets, and then across different product in the markets, right? When it comes to the business plans of the real estate themselves. So I think you hit the nail on the head with that.
Yeah, so exactly that operational strategy. And so with that, I mean, I do know that we had some people join in a little bit later, so feel free to leave any question or comment in the chat. If you leave it in the question section, it is anonymous question directly to us. If you leave it in the chat section, everyone can see it, just so everyone is aware. If they feel a little bit concerned about dropping in a question that may or may have been answered already, we're always open to any and all questions as it relates to real estate investing, especially given the fact that we built this platform to educate everyone about real estate investing as they're continuing to learn while you're in. I mean, that's why this new segment of the webinar is so prevalent and such a massive priority for us. Is every single last week of the month, we're going to have at least one webinar on the go forward. So with that, to incentivize people to continue coming back to the webinar, I believe we have a surprise property drop live as we speak. And so Thomas will drop that in the chat if he hasn't already. So with that, yep, it's the Victor. And so named after what's his last name? The Victor.
Victor Mateo.
Victor Mateo in Billions. Joey had a chance to name this. You want to give a background as to why the name?
Yeah, 100%. I thought it was I was telling Alex when we were deciding the name, this property had relatively one of the highest cash flows I'd seen in terms of NOI to cost basis, which is great and tremendous and great for operations. A little bumpy around the edges in terms of the CapEx we wanted to put into it initially with our tremendous team over at TPM Partners that's going to be managing all of our pad splits in the Atlanta area. So they have connections.
Real quick, Joey.
Yeah.
Real quick, if you could spread out if you can widen the browser, it's looking like it's, yeah, there we go.
Is that better?
Before it was in the iPad model. Anyway.
Oh, perfect. Sorry about that. Yeah. So long story short, little tiny bit rough around the edges, but hey, when you're dealing with a monster cash flow vehicle like this, that's part of the pad split model, right? Is investors, from an investor perspective, like to take on a little bit more deferred maintenance when it comes to the quality of the assets, but that doesn't mean that we don't have the opportunity to work with some of the best GCs in the space to, one, optimize any deferred maintenance at closing, making sure that we're taking care of all of those things day one from the inspection reports. We call them inspection report repairs. We work directly with the GCs to address every major item and every major item that needs to be addressed within kind of a 2 to 5 year time span, right? So if it's something that's still has a 10-year lifespan on it, that will remain deferred maintenance and be passed along to the next buyer, kind of assuming that 5 to 7 year hold. And then if it's anything that needs to be addressed immediately, we work with our GCs. So this is the Victor. Incredibly strong fundamentals when it comes to cash flow here. The actuals on this property were already above $56,000 for the previous 12 months, the trailing 12 months, and that was post pad split fees. So we underwrite our go forward rents below actualized rents, and that's pre pad split fees. So that's actually even more conservative, given the fees will come out of the gross rents that we're underwriting going forward. So just as a high level, this one's again the Victor. It's out in Southwest Atlanta. It's right across from Cascade Park, which is a really cool nature reserve trail. And effectively, it's a 7-bedroom, 3-bath pad split. And we went to our lender, a Coast to Coast Mortgage, secured a 75% LTV loan at 6.5%, which is tremendous. That's again operating at the rate floor. We will continue to operate at the rate floor with all of our lending partners, and hopefully that rate floor will only continue to go down, as Alex mentioned, going through this year in 2025. Thinking about some of the kind of comps in the area, one thing I do want to touch on is the tenancy here has been really strong. It's at least 9+ months, which is amazing, given the pad split model and the midterm rental model can sometimes attract a lower kind of tenancy, a higher rate of turnover, which accounts for higher fees, in addition to obviously a higher kind of vacancy, right, when it comes to the amount of rent that you're collecting each month for gross rents. So thinking about some of the comps in the area sold, there's plenty of justification for properties in a very similar build within a 2-mile radius that have sold all within the past 3 months in 2025 for a similar cost basis. And if you look at it from a cost per square foot or cost per unit, definitely much higher than what we're looking at the Victor. So the appraisals coming in, where we'll obviously post that once that comes in, but all of our properties on the pad split model have appraised with our lenders at Coast to Coast. So very confident about that. If you go into the property page, obviously you can play along with the tool here, which will show you your base bull and bear case underwritings on a yearly basis according to how much your investment is on your initial principal that you put in. So say I want to put in a $5,000 investment into the Victor. The base case is going to show me what exactly the yield is that I'm receiving year one. So that's 11.2% levered cash on cash yield directly to my pocket, which is about $558 on my $5,000 invested. And then your appreciation is that levered appreciation that is accounted for by the property's value growth, but that value growth according to your equity that you're putting in, right? Because the lender has that pre-negotiated rate on the leverage that's in place for that loan. So again, you can go through base, bull, and bear case and see exactly what your cash flow, your appreciation will look like on an annual basis. You'll see the fundamentals that we're assuming here. Again, just some of the major operational and then also capital markets fundamentals when it comes to value growth. So thinking about the timeline here. So this property is set to close in April. We got this one under contract here in late March. Went through the inspection report, got actually $10K of additional seller paid costs towards the closing costs, which is tremendous, and brought the purchase price down to $310,000 from $320,000. So a huge win overall. And again, that's all going directly into the deferred maintenance that we discovered from the inspection report. And that's how we like to handle kind of our pad splits that are turnkey pad splits, but are less kind of turnkey hotel ready, like you might see from some of your Airbnbs.
And then real quick, Joey, on this part too, if you can scroll up just a little bit.
Yeah.
One of the things that the property status, the property status. Yeah. So one thing that we really want to highlight, because I got an email actually just before this call about this, was I've invested in a property. Why hasn't it yielded yet? Why hasn't it paid off dividends yet? And really it comes down to the operational status of an individual investment. And so by that, I mean, a lot of these assets are either in the acquisition phase or they've already been transitioning over to us. And so when that happens, we decide to obviously list it out when the capitalization is fully capitalized and we have the funds to close on the property. And we'll always do a incredible job about closing early if we can, if we have those funds. So for instance, on the Johnson, we're trying to close that a little bit earlier than anticipated there. However, outside of that, we try and be as conservative as possible when it comes to the property status, with the idea being that we list when the property is purchased and when we anticipate that turnover to happen. And so for instance, in this one, the April 2025 date, we anticipate closing on it midway to late way through April 25. And because this is relatively plug and play, we should have at least a little bit at the tail end of the month of dividend payout. And that being said, too, the interest payment isn't due on the loan in that first little bit. And so we can pay out relatively quickly on this asset as opposed to some of the other assets. So for instance, the Johnson had definitely a little bit longer of a timeline where we're looking at full month of operation in May with the first payout in June. That's not to say that your asset isn't appreciating over that time, because obviously the markets continue to trend in hopefully the direction that we anticipate to trend in. And so with that, just wanted to highlight the property status, but keep on going, Joe. You're crushing it. And outside of that, we do have some questions that we can pop into at any given time on this asset.
Yeah, I mean, you're 100% right, Alex. I think it's really important to note that, every property has a startup period, right? Just from when you go to closing, you got to make sure your property manager is plugged in. You got to make sure your contractors are plugged in. You got to make sure all operations are fully smoothly transitioned, including utilities, right? Including the loan. Everything is in place to make sure that this asset is operating as that asset that you then one click invest into on the platform, which is great. And I think, one of the things that's really important too is not that we should be, guaranteeing that real estate's a long-term game, but when you're thinking about kind of the 1 month drag on your first yield dividends, as Alex said, that doesn't play into the basis that you're investing in, right? As the asset continues to appreciate, that doesn't play into the dividends that you're getting in your first full year of operations from kind of that full closing and capitalization and that first 12 months of operations. So, 1 to 2 months for a starter period is perfectly normal for an asset, and we expedite that and accelerate that as much as possible. But it's perfectly natural. So that's a really good point.
And we do a great job too if the asset isn't sold out before it's started yielding, or even if it has sold out, you start accumulating and accruing interest almost in that dividend. So you should have a greater proportion of the first dividend if you've invested earlier in the property versus later in the property life cycle. And so that's as an extra incentive to invest earlier. And we know obviously that we will be continuing to turn over, or at least move as quickly as we can on our end, especially given that the property purchase date. I mean, the fact that, for instance, high level, didn't we take over the Axelrod like 11/20 and paid out our first dividend like less than 2 weeks later on that?
Yeah, that's right. That's right.
And there were a lot more like that. I think the Rhodes was one of those. And I mean, the Axelrod paid out 1% plus in December and was the first month of operations. Anyway, go for it. Continue going, Jeff.
Yeah, 100%. And this one will actually be the very same. It's already fully stabilized, 100% occupied, as I don't think I mentioned yet. So it will be the exact same scenarios that Alex just outlined. Just kind of rounding out some of the analysis on the fundamentals here. This is your capitalization, which we show on every asset. You're going to have your purchase price. You're going to have your 75% LTV debt going into that purchase price here. That's the equity that you're putting down as your down payment. And then on top of that, you have your reserves and your closing costs, and then our capitalization fee that we charge to keep the lights on, which again, when it comes to your return, you're amortizing that over the full hold of the asset. So it's very, very minimally dilutive in terms of turning kind of, again, your 18% IRR into that 17.4% IRR. And again, when that first year yield that you're seeing and that average yield that is advertised across every property's card and across every property's analysis is actually already including all of your capitalized costs, right? So that's your levered cash on cash yield post fees directly into your pocket pre-tax benefits, pre-potential tax benefits. So as Alex mentioned, just thinking about the kind of the hold of the asset, we have our typical 5 to 7 year hold period. And then if you go down, you can always see the market info in terms of where exactly you're investing in the MSA, the previous kind of 5-year market rent increases, the 5-year appreciation, and then a lot of the fundamentals that are currently driving growth in the market down here. Per usual, you can find your documents, including the operating agreement and the purchase agreement here. And then as we said before, our partners here are on the lending side, coast to coast, and then on the pad split side, they are the ones that manage the property, and we have a team in Atlanta that manages the properties on pad split for us. So we can open up to questions here on this asset before jumping into any others.
Yep. Yeah, we do have some questions here, and I can rattle some of them off, but also anecdotally too on Atlanta, that's definitely a market that is continuing to outperform, especially from an appreciation as well as rental income perspective. You have major Fortune 500 companies and fintech players moving into Atlanta. Microsoft has devoted over $1 billion to build out their HQ2 from their Seattle office was their first one. So now this is going to be their HQ2. out here. And so just goes to show you that there is a massive upswing in the Atlanta, Georgia market, and it definitely hasn't been priced in fully yet. So number one, right off the bat for this property, Joseph's Cachapaglia says, for the Victor, why doesn't the $2,300 square foot on the Mogul page match up with the county data of 1464? Is there an addition that the county isn't aware of?
So it's not that the county isn't aware of, it's improvements made upon the property, right, including the conversion into the pad split itself. So when you're taking into account the livable square feet, one, as Alex very well knows, being MLS licensed, there's always going to be discrepancies between county data, MLS data, and actual data a lot of the time, especially when it comes to an asset that hasn't sold in a long time. I forget exactly when last this asset was sold, but I know it was in the hundreds of thousands of purchase price, like in the 100,000 purchase price, and has appreciated quite a bit since then, obviously. But there's always going to be discrepancies in the data when you're looking at county and MLS level data. However, this is directly taken from the survey and directly taken from the as-built, from the measurements that are taken from the livable square feet, including the conversion into the pad split via the bedrooms that have been set up. And so if you look at the pictures that were included actually in here, you'll see a 3D model of exactly what the layout is today. And then you'll be able to see, the second floor, the first floor, and then the aggregate of the home altogether in terms of what that layout is now. So you'll always see discrepancies. Again, the high level is in data with MLS and just all around. And even if you look sometimes between the Redfin and the Zillow, you'll see discrepancies on square footage. You might see discrepancies on other major data points. We will make sure that all the data in terms of the asset level data on the Mogul site is 100% accurate according to the data that we're receiving from title, that we're receiving from the county as we go through the ownership takeover process.
And then also on that too, it is a net benefit too if the county lists it at a lower taxable square footage, because that means that it will come in at a lower valuation, which means that it'll come in at a lower property tax from a taxable basis. That doesn't obviously change what the market value of the asset is. And so it actually is a net benefit. Also, when do you expect the analysis tab to be up for this one? I believe it should be listed tomorrow when we list it live. Is that right, Joey, on that?
That's right. So the calculator typically gets published fully when we have the asset fully live and launched. So this is a pre-launch, right? This is a kind of first look, and Thomas can drop in the calculator link that we customize before it's fully published if you want to take a look at it. However, the published calculator will match what that customizable calculator is once we launch the property tomorrow. That's right.
Perfect. And then one of the other question is just how accurate is the projection model in terms of base case? I'm happy to dive into a little bit and then turn it over to you, Joey, if that works. And then
100%.
If I'm missing anything too, feel free to chime in. But we are relatively conservative, especially when it comes to our projections, even in base case scenario. And so a lot of times we'll take the actuals as performance over the last T12 months, and we'll apply that as year one rental income. And so by that, I mean, think about how something grows year in and year out. And so today, obviously, your dollar is going to be worth a lot less than it is tomorrow. And so when you think about it, inflation naturally pushes rental income upwards. But we're taking a conservative estimate from the projected yearly rental income in year one. We're actually taking from the previous historicals of that. And I think actually Thomas just dropped in the calculator for this one, which is obviously definitely well ahead of schedule. So definitely feel free to take a look and play around with that. But as for our conservatism, you can't expect it to be exactly directly in line with base case when it comes to projections, because we're obviously doing our best in terms of weighing the pros and cons, the returns and the appreciation, as well as the growth of the rental income on the go forward. However, all that to say, we are very conservative when it comes to the base case, and I think all of our assets have outperformed our base case underwriting, unless correct me if I'm wrong on that, Jay, but I believe we've outperformed every single one across the board, which has actually been obviously incredible.
That's 100% accurate. And I will touch on that too. This is a great case study because this one, as I mentioned before, but don't want to kind of just dive past it in the initial analysis, is that this one had $56,000 annual payouts in the past trailing 12 months. And that was self-owner managed, right? So we have a professional management company coming in, marketing to market the asset, making sure the rents are kind of where they need to be, making sure that tenancy is up, making sure that the length of the tenancy is up. And this is a very, very conservative estimate. I would never say that we sandbag our assumptions in any of the properties that we do. However, we are very, very conservative. And as I was constructing the model 2 nights ago, I was actually looking at what the returns would look like with the full $56,000. And obviously it makes a tremendous difference when it comes to the year one yield, the average yield, and the average IRR in multiples of basis points. So I'm talking, 4 or 5% just from increasing that rent to where it was in the previous 12 months. And again, we go through a lot of diligence when it comes to the first 7 days in that option/diligence period. It's referred to as kind of the diligence period in several different states with several different names. But in each contract, there's a pullout period where effectively for 7 days, I pull in our property management teams to do a deep dive into each of these properties. They actually go and do an on-site visit or post going under contract pre option period expiring. And they will make sure that there are no what they call lemons. I learned that term actually the other day. Anything wrong with the property that would make us want to walk away in that due diligence period. And so that'll include scrutinizing the rent, scrutinizing if there have been any issues with any tenants, any eviction processes going on right now, both on the Airbnb and Padlet side. Any previous litigation against the owners or the current tenants in the properties. And so we scrutinize all of that pretty heavily. And again, I don't want to say that we would ever sandbag assumptions, but in the base case, we're being very, very conservative about what these rents will be on a go-forward basis.
You just learned the term lemons? That's
lemons as it relates to real estate, I guess.
I mean, Jesus. Anyway, that's some of the questions that we had. Obviously, this is a VIP launch, so those of you on the webinar, I will mention that there's only 160K in this property, give or take. I think it's about 158K. So with our last few assets selling out rather quickly, I would definitely hop on earlier. That's why we're giving kind of a 24-hour period. I mean, the Celeste raised over 150K in a couple days there. The Prince sold out in less than 3 days, which was like a 400K raise. So definitely wanted to give all the people that tuned into the webinar kind of a early access, so to speak, to it. With that, there are some general questions that I think we can leave until the end, unless there are any other one. Is the property currently occupied? We answered that. One about the square footage, the analysis, base case. I'm new here. Read dividends is a cumulative preferred return paid after 3 years, or will we see those dividends show up in our invested balance among monthly from day one? I'm reinvesting dividends. The idea with that is, I think Tim, if you want to reach out to me separately, that's actually on the fund style model. And so that's actually a different conversation entirely. It's paid out. The dividends are actually distributed in more shares in the fund. So it's already reinvested. And so with the fund, given it's a 3-year horizon, that would then pay out at the end of the 3 years, but it'll appreciate over time because it's getting reinvested back in other properties. Outside of that, can you talk about the liability for investors? For instance, what if the property burns down? Is there insurance that protects our principal? What if a tenant gets hurt? What if a tenant gets hurt so the property and sues? How are we as investors affected by this? Can a tenant go after us for damages? Should we set up a separate LLC for each property? So a lot of questions, but it really refers directly to the risk and obviously liability. When you invest in a property, you're actually investing in an LLC that owns the property. And so that LLC already has limited liability. So worst case scenario, if a renter were to come at the property, they could only come after the LLC. And so they couldn't come after you as the end investor because you have protected or limited liability as it relates to the ownership in the property. So they couldn't come directly after you. Now, as it relates to what if the property burns down, is there insurance that protects our principal? Yes, we actually take out 2 forms of insurance, which we think is obviously extra in terms of the risk mitigation that we have. But when it relates to it, it relates directly to the operations. And by that, I mean we take out property and casualty insurance, which obviously covers in the event that the sky is falling, or in the event that the roof caves in, or in the event that the property burns down. And so that covers that angle. Now, we also have landlord insurance, and landlord insurance is a specific kind of insurance that actually protects you in the event that a tenant goes after you for damage. But also one of the cool aspects of it is if an asset for whatever reason gets taken offline, you actually get paid the market rent value as if it was fully occupied. And so a case study that we had was one of our properties, the Roman out of Houston, Texas. Hurricane Beryl came crashing through there. Our property sustained very minor damage, and by that I mean the fence was 100 or 20 degrees off kilter. It cost roughly $100 to repair. Wasn't a major capital expenditure, and with that, it actually triggered landlord insurance. And so even though we had to take that asset offline during the time of the hurricane, we were able to pay out to end investors a 1.22% monthly cash on cash yield from an asset that was in the midst of a hurricane, and that was due to the landlord insurance being triggered as it related to that. And so that's on as it relates to the risk mitigation. Yeah, so I mean, if that, Ryan, if that answers all the questions, definitely let me know. If it doesn't, definitely let me know as well what we can add to that.
Yeah, the one thing I would just add super quick there is that's you are 100% right. It's liability insurance is a umbrella supplemental to the landlord insurance. So that's exactly right. That covers us up to $1 million in terms of damages and suing effectively. And then on the loss of use side, that's exactly right. It covers us up to 12 months of loss of use, and then before you have to take out another claim. If the property is unable to be used, you get covered for your top line rents according to previous performance. So 100% right.
Perfect. And then there is one other question as it relates to this property. What is the typical nature of the renters for properties with all these bedrooms? Is it a vacationers or something else? And by the way, it is individual rooms being rented out. It's not the whole property being rented out. But Joe, if you want to cover the typical nature of the renters.
Yeah, 100%. So it's a rent by room model, right? So you have a lot of traveling professionals like traveling nurses, individuals that are assigned to different projects, whether they work for a large GC and they're traveling around the country for different projects, or they're working at, like different Amazon warehouses, right? And they have to be assigned to different projects around the country. That's a very typical thing that we see along some of the industrial corridors, especially in like Atlanta and Phoenix. So that's kind of the typical renter demographic that you're looking at. It's more your traveling professional that doesn't necessarily need a home for a full year or even 6 months, but doesn't need an Airbnb for 3 days. It's more of a monthly kind of living situation, if you will. And so that's why Pat's has become so successful, is because the demand is so strong for these midterm rentals. And we've always, even when we were at Goldman, we always looked into the kind of workforce housing thesis in terms of that midterm rental business plan to kind of bolster, multifamily long-term fundamentals when it comes to shifting markets. And so that's one of the reasons why we love the Pat's model so much. And we have tremendous rapport with our property management teams in all these markets, boots on the ground, who then also have tremendous rapport with the tenants in each property, which I'm starting to see very quickly.
Incredible. Well, there is one last question. To be honest with you, this one isn't related directly to property. And because we've answered a majority of the other questions, I mean, at this point, maybe we just answer this one before we move on to the next property there. But again, this is VIP sale, so you can buy into it before it goes live tomorrow when it goes live to the public. And so this one is, I know you all mentioned the secondary market is set to launch Q2 of 2026. But aside from that, if I were to say invest today leveraging debt, would I be able to use either the rental income or the earnings from my property appreciation to make my loan payments? And so with that, what I think you're doing is trying to buy on the margin for the real estate that we hold on the platform and use the rental payouts to pay back the interest payments. And so for that specific question, I mean, it's completely up to you what you do with the rental income. And so I would take into account the projections. I would take into account, obviously, there are some months where it's up, some months when it's down in terms of the actual rental income. You'll get 1 month where it's a 1.5 yield and 1 month that it's a 0.8 yield, right? And so by that, I mean, there is some variability, especially if it is a short-term rental or even a midterm rental in some cases. And so if you're using it to pay back interest, I would say always have an interest reserve. I can't give any sort of investment advice out to you as an individual, completely up to you, but take into account we do pay out on a monthly basis, so second Tuesday of every month, but also definitely take into account when the first dividends are expected to be paid out, because that's obviously crucial to when you would invest, to when you would expect to have to pay back the interest. So Langston, I appreciate the question there, and feel free to ask me any sort of question as it relates that outside of it. And so with that, I mean, that's the overview on the Victor. I know we actually That took a lot longer because we had a lot of questions, which is obviously always a good sign, and we left a lot of time for Q&A. Joey, do you want to run through like 10 minutes or 5 minutes even on the Celeste, and then we can dive into some of the questions that were lobbed in even prior to this call, as well as if you have more questions, feel free to add it to the chat as well as the questions link there.
Yeah, 100%. Let me know when you can see the Celeste property page here.
Oh, there it is. Beautiful.
Yeah, I mean,
Also, this one was if it's a reason why it doesn't follow any other trends as it relates to the naming aligning with the. Also, we should probably do a quick Johnson one because both were named after some pretty major investors. And so the Celeste, we sold the naming rights there, as well as the Johnson, we sold the naming rights there. So if you're wondering why some of them differ from other properties, it was due to our incredible investors that are major investors. I don't know if they want me to mention their name at all, so I probably will hold back on mentioning their name until they give me the sign off there. But they did name the assets, so thank you again for that one. For investing in the asset. And so want to run through the Celeste and then obviously the Johnson, given we have like less than 50K, do speed round, 4 minutes each.
Yeah, so super quick. I mean, this is an absolutely beautiful turnkey rental. Again, this one's out in Houston. If you just look quickly at the location, you'll see it's right near, kind of similar to where the Axelrod is, kind of directly south of downtown Houston. Incredible property, or sorry, not the Axelrod. Actually, I'm thinking about the Shiv. And so a tremendous location in downtown Houston, super close to a lot of amenities. It's a 6-bedroom, 4.5 bath with all 6 bedrooms having direct access to a bathroom, which is great. It's 3,500 square feet, fully amenitized in terms of having that backyard, having the hot tub to boot, and a lot of games in a garage as well, in addition to a professional pool table that had been installed. This one we secured at about a 4%, a little over 4% actually below where asking was. This was an off-market deal. Oddly enough, not to disparage anyone, just the seller decided to list it after we had it under contract for data purposes. So we ended up getting this one under contract 2 days before they listed it, which you'll see from the purchase agreement. And that was about 4% below where the 920K was that we were asked about it. 70% loan to value with Host Financial, our lender on the short-term rental side, at 6.75% right now. And that, again, those rates fluctuate according to loan size, according to market, according to DSCR. There's a lot of factors that go in, but we're operating at the floor. They actually haven't brought their floor down to 6.5 quite yet, but that is imminent. This one we are projecting at 126,000 of year one rental income, which is below, again, 130,000 of previously received trailing 12 months income, just very high level. And again, that's pre and post fees, right? So the previous was post fees in terms of the fees that are already deducted from that rental income. And then this 126,000 isn't even accounting for the fees that will be deducted after that for a lower effective rent after your gross rent. So very, very conservative in our underwriting. You can go into the comps here. They are really self-explanatory in terms of justifying the rents that we're looking at, in terms of justifying the cost basis that we're looking at. Same tool here that you can go through and kind of check out your base bull bear case in addition to the calculator that we provide. And then, you can see obviously your capitalization metrics here, and then down to the market, the performance of the market, and some of the current drivers in the market. So, this one was for me super fun to get under contract. Went out and saw it with Umberto, off market deal again, and the seller, was very kind of sad to see this one go, but had capital needs elsewhere. So we got it at a great price, and again, fully operational Airbnb. Will be quick to turn over, and shout out to Umberto, who will be taking over operations imminently. So that's a quick overview of the Celeste. If there are any other questions there.
Yeah, I mean, none that I'm seeing in the chat. No, if you want to turn it over to the Johnson, one of our bigger properties, the Johnson is a big property of ours, and so this one's obviously an absolute beaut out of Austin, Texas, and rip through it.
Yeah, no, I'm happy to. So we are very short away from kind of our sale goal, right, of the 655,000. We have about 50,000 left. This one sold out super quick, which is great to see. This one again also speaks for itself. It's a turnkey Airbnb out in Austin. One of the first that we've done in the market, again, just getting a lot of conviction around the micro location, kind of in that Cesar Chavez neighborhood, making sure that we have a lot of conviction around kind of the attractions that are growing in that area, the cash flow fundamentals when it comes to the operations of the Airbnb itself, and then making sure that we have that accretive leverage, right, that valuable leverage in place where that APR is much lower than the yields that we're looking at going forward, to make sure that we are getting additional value from leveraging up versus just buying this all cash. So, similar analysis you can see for yourself. You can go in, see the comps, which will, again, more than justify the cost basis, more than justify the rents that we are looking at here. Actually, a lot of the properties on this particular one were very, very highly performing. There are properties nearby that are nearly half the size that have already achieved over $300,000 in rents, whereas we're projecting $210,000 in rents going forward. So this one's actually just left of the highway, across from Cesar Chavez, more in downtown, southern downtown Austin versus where this kind of micro location is. A lot of that baked in growth, as Alex mentioned, isn't here yet, which is great. That means there's a lot of growth to be had in this micro location, whereas where these kind of turnkey properties are operating, it's a little bit more topped out in that particular micro location. And I did provide a supplemental analysis on kind of the Austin market, what we're looking at in terms of fundamentals from that rent growth index, as I mentioned before, and how that attributes to value growth going forward. We are definitely coming out of the dip. We have high conviction around saying that, where the decreases have come down from upwards of 25% through the COVID dip, the post-pandemic dip, or I guess the dip from the rise that happened, during the pandemic in Austin. We're definitely seeing it kind of level out and start to increase in terms of value growth going forward. So I'll pause there. I know there might be some questions, and we don't have a lot of time for Q&A, but definitely go check this one out before it sells out.
Of course. And with that, can Canadians invest? Is there a lock-in period? There's a lock-in period. It's between 5 to 7 years. However, we hope to get a secondary up online midway through 2026. Outside of that, Joseph Cachbaglia said, when the Celeste went live, there was 80K sold out almost instantly. Does some of that represent investment from the Mogul team? I know you've mentioned that the team invested in the Mogul deal. Do you disclose anywhere how much of the deal has been bought by the team members? To be honest with this one, part of that was due to the fact that we sold naming rights for about 50K in the property. So someone came in and invested right away prior to the sale. So they wired us over the funds. And then that was sold out. Yes, I mean, some of it is attributed to Mogul investors. Myself and Joey, as well as our employees, definitely invest in each of the properties. I mean, this is where I hold all of my assets. And so there was that, but at the same time, there was a lot of demand around it, just jumping out at it. And so a lot of people do tend to jump online, especially given the fact that we'll be reaching out to people individually. For instance, if they do have high interest and are asking for instant notifications or even pre-notifications prior to being listed. And so there's something around that too. So to the extent that you obviously want, what do you actually mean by naming rights? I meant they actually went ahead and named the property. And so the asset itself, typically speaking, we named them after Secession or after Billions characters. These assets were named after the individuals. They decided to come in and name the assets, given they are pretty high power users, and in returns for making a large investment. Exactly. So they made, it was, I believe, 50K in this asset, or the Celeste was 50K, the Johnson was 100K. And I believe on the go forward, it'll be between that 50 and 100K mark. In return for making a large investment, we give the opportunity for them to name it, because this asset, hopefully when the secondary comes online, will live into perpetuity. And so it just goes with the asset itself. So it's a fun little thing too, for naming the asset. And obviously, of course, that comes with due diligence into the asset, but once they have conviction around the asset is when they're able to purchase the naming rights with it. And so with that, we can jump into a lot of the questions that we had. And Joseph, it's great to see you here, because we've been definitely watching some of your videos. So I think some of these questions are coming in directly from some of the videos that were being listed. So we wanted to give a chance to answer some of them here. Obviously, if anyone has any other questions, feel free to throw them in the chat and we will continue to answer it. If you invest from Canada, you can invest from Canada. Just be aware that there are some specific tax laws around Canadian investment into investment in the US. So just be aware and cognizant of that when you are making the investment. So if you have any questions, feel free to drop them in the chat. First one, right off the bat, confused about us saying 4% below asking price, where it was listed at 885K for the Celeste. Well, that just goes again to what Joey had said earlier. For some reason, we're not exactly sure why, the individual decided to list the property after we had it under contract. And when they listed it as pending almost immediately, as if to be persuaded otherwise that they could potentially sell it for more or for a different price than what we were paying it for. But we were already locked into the contract and had exclusive rights to purchase the asset with them from that. And so, Joey, I don't know if you want to touch on that at all.
Yeah. Again, zero disparagement against that decision. There's nothing wrong with that. Technically, they're fully able to do that as long as they show the right status, which is pending. But I just do want to note, if you look at the PSA, we had it under contract 2 days before it was listed on the listing service. So definitely odd, but it out of the norm and just something that happened. It's all good. But just to be very clear, we were approached off market to purchase that property at $920,000. We ended up getting it at $885,000. So that's where the 4% is coming from. And there were 3 counters that we went through over a 2-day period to get to the final terms that we decided on, including, again, those furnishings that convey, which is a point that I actually don't think I went through going through these properties. Typically, there's a lot of value in the furnishings that are conveying in the Johnson. We itemized the value to over $75,000 of furnishing conveying in addition to the contract. And then with the Celeste, there were $50,000 of furnishings that conveyed in addition to the purchase, outside of the basis discount that we negotiate through the option period. So
incredible. And then also, what if one of the questions that just came in the chat, what if the full amount of money is not raised for a property? Will dividends get delayed? So obviously we do our best job to raise out for the individual property, and there is a certain amount that needs to be raised in order for a property to be closed on outside of the platform. And so when you think about it too, we don't need to raise the full amount in the platform. So for instance, if it's a 400K raise, like in the case of the Celeste, we probably only need about 250K to close out on the property. I think it's between 265K with an incremental closing cost of about 40K on top of that. So you're looking at roughly 300K. We have 150K of it 150K of it raised. We anticipate a lot more to be coming in the coming days for that individual asset. So in the event that we aren't able to raise the full down payment plus the closing costs, Mogul will come up with the payment and true it up to the total amount to close out on the asset, and then continue to syndicate it down over time. Because again, that's just the high conviction that we have around the individual assets, is we're willing to take it on our balance sheet and get it fully rent ready and get it dividend paying out in the event that happens. And so will the dividends get delayed? We try and make it so that we can close out on the property regardless of anything. And so if that is the case, then hopefully we won't have to delay the dividends there. And so if anyone has any other questions, feel free to drop them in the chat. If not, I can run through some of the questions that we had been lobbed in also before and during the call. And so in one of the videos, there was a question around someone liked Houston a lot, but worried that so many of our properties are located there and in a couple of other markets. Why do we invest so heavily in Houston? And on top of that, have you considered San Antonio, given it's in some ways, in some people's opinions, similar to Houston? So I guess just would love to hear your thoughts, Joey, about the San Antonio versus Houston market, but also why we're so into Houston or into investing in Houston. And by the way, it's not to say anything bad against San Antonio. Obviously, it's a phenomenal city out there, but it's just, again, conviction and investment thesis. So Joey, if you want to walk through that too.
Yeah, I mean, I really just always look back to the data. Again, San Antonio is a great market. I think there's a lot of value to be had there. Similar to Austin, right? Our outlook on Austin 4 years ago was a lot different than it is today, when kind of it was at the peak of that tipping point, right? As it was kind of going past the higher pricing and kind of dipping down. We definitely saw that coming. We definitely talked about it pretty openly. And then now, almost 4 years later, we're bullish on Austin because we see the value in a lot of the pockets, the micro locations around some of the submarkets that we're looking at, in terms of where that like Alex said, that growth hasn't already been baked in, right? Where it hasn't already been achieved, or you can actually achieve that in a go forward business plan. So when thinking about just 2 different MSAs, the honest opportunity, or the honest answer, is that we just haven't seen the right opportunity yet. It's not that we're completely averse to investing in San Antonio. It's that if I'm finding an opportunity in Houston that has a 10% plus NOI yield on total cost basis, and that's proven out with over a year of actuals, I'm going to keep doing that all day long. I mean, that's proven diligence, that's solid fundamentals, that's just good real estate. That's something that you want to keep your eye on, right? When it comes to thinking about off-market deals, when it comes to navigating in the single-family rental space. We are looking to expand into additional markets, so you'll probably see assets coming about in, Denver, Charlotte, Nashville, to name a few. And San Antonio is definitely on the radar. So I wouldn't say that we count it out by any means or discount it by any means, but right now we are definitely tracking the market really close, and that's the good part about doing it on an asset by asset basis, right? We're not investing your money through a fund and then just putting properties into it quite yet, but we are able to kind of flow with the market and choose those individual assets based off of the individual value proposition that they present through operations, through the market fundamentals in the MSA, through the considerations around property management, through the considerations around the debt that we could get in that market, right? Like even debt will vary across different markets. And right now, DSCRs are killing it in Houston, absolutely crushing it. We've never had a problem qualifying DSCRs above 1.25x on any asset that we presented to any of our lending partners, which they have even quoted is completely out of the norm. So again, when it comes to us kind of not reinventing the wheel, making sure that we're staying really strong on our fundamentals, staying conservative, we'll continue to do that in every asset in the pipeline. So that I hope that provides some clarity there.
Yeah, and I mean, Joseph, thank you again for obviously going through it and reviewing our assets, and not you, Joey, but the other Joseph. But because I know you're also Joseph, so Joey, not you, but Joseph in the chat. Thank you so much for going through and reviewing, obviously, the platform and the individual properties. Keeping us honest is exactly what we hope to do here, is keep full transparency into the operations of the asset. And so for whatever their reason, there is any other kind of questions, comments, concerns, we're more than happy to answer any of them, and especially in a public setting and public forum, and give complete transparency into the operations, because there's obviously definitely a method behind the madness. And so if anyone does want to check out some of the property reviews outside of ourselves, there is a great YouTube channel that reviews the journey of Joseph throughout the entire investing horizon on Mogul. And I definitely would highlight too, it's in this industry, you can't have enough transparency when it comes to investing in real estate, especially with the amount of fraud that has come to the market, even prior, and some of the competitors that have come to market and have shut down subsequently within a few months. And so definitely really appreciate that highlight within the industry. Outside of that, there was a question around, even though we are paying a discount to market, why are we paying higher than some other assets in the area? And so, I mean, they're obviously, when you consider, and I can answer this, Joey, unless you want to answer it.
No, go for it.
You seem like you're chomping at the bit to answer this.
Oh, I'm ready to go, but yeah, please, by all means, go for it.
No, I mean, so when you consider what you're looking to pay for in terms of the actual asset itself, you can take the appraiser's approach to it, which is a 3-method valuation to the actual asset or the underlying asset. So when you think about it, it's the sales comps, the cost approach, and the actual income approach. Now, typically speaking, the appraiser, if it's not a DSCR alone, will heavily weight the sales comp over the other two. And on top of that too, even in the event of a DSCR loan, a lot of times they won't really value the other two nearly as much as the sales comps in the market, because if you think about it, market price for an individual asset, which is exactly what they're trying to attribute there, is what someone's willing to pay for the asset. And so they have to take into account the sales comps in the area. Now, when you take into the sales comps approach, you take into account, obviously, there are a number of different houses within a certain radius of an individual property. Now, for an individual asset, whether it be a 2,500 square foot, 3-bed, 3-bath townhouse or a single family rental, you've got to compare that against other 2,500 square foot, 3-bed, 3-bath apartments. Now, what if one of them is a 3-bed, 2.5-bath, but has 2,500 square feet, or one of them is 3-bed, 3.5-bath, and has 2,400 square feet? And so typically there are a number of different factors and levers that you have to pull when it comes to comparing from one asset to another, especially as it relates to the sales comps. And so when we look at the individual assets, we obviously take into account the vintage of the asset, when it had been renovated last, the obviously asset itself, are we getting furnishing, conveying with it, and does it come still within underneath the purchase price of the asset? So technically you're financing part of the purchase of the furnishing as part of it too. And so at the end of the day, we definitely do heavily weight the sales comp, but that's not to say that we don't look at the cost approach or the income approach, because obviously cost approach is, if that asset were to be knocked down and built up tomorrow, what would happen? How much would it cost there? Income approach, you get the, what would the income be for the asset, and you approach a rent multiplier to it. That's that. I don't know, Joe, if you had anything else.
No, that's 100% accurate, spot on. I think the one other thing I would stress is that you might find an asset like a diamond in the rough that someone paid an absurd premium on, and that's really just emotional buyers, right? When you're operating the world of single family real estate, there's always going to be emotional buyers that are willing to pay a premium for something, even wiping their appraisal contingencies, wiping sometimes even inspection contingencies, right? Just to get that asset, right? And sometimes there's multiple bid processes that drive those prices up, and they're willing to drop that appraisal valuation, as Alex walked you through, in order to pay that premium. So you're always going to find, if you dig deep enough within a 5 mile radius of any property, you're always going to find something that was paid for by a very large margin, a premium, and then stuff that was also got at a discount, right? Because on the sell side, there's also emotional sellers that need to get out of properties for discounts and have timing considerations and capital needs elsewhere. And there's a lot going on in the world of single family real estate that isn't as prominent in kind of the more, open commercial multifamily market that you see. But yeah.
Perfect. Well, I mean, that's our time. Thank you so much for everyone for joining us. Just an update too on tax forms. We're in the process. We've been working through them profusely. They should be turned over to our tax team tomorrow, and we were told 10 days from that is when they're going to be fully set out. I will highlight that obviously we've done this now for the tax forms this year, and we have a lot of processes in place. So next year they'll be coming even earlier, but we do appreciate your patience there. But outside of that, the tax forms are on their way, and we've been working night and day on those individual tax forms. We will convey obviously the information that we're given tomorrow when it comes to the exact timeline of when we can distribute to the individual. But is each property brought under its own LLC? Atule, thank you. No, I can lob this in real quick. Is each property brought under its own LLC, and where your LLC is registered? They're each individually registered on the Go Forward in Delaware. Joey, correct me if I'm wrong on that. And so each one is going to be an individual LLC that owns that asset outright. So with that, I think hopefully that answered it, Philippe. So appreciate your time. And thank you so much, everyone, for joining us. We'll be doing this on a monthly basis. If you have more questions, feel free to lob them in. We can answer them even beforehand. Joey, you're smirking. I don't know what. Anyway.
No, I'm just happy. Great webinar.
Thank you so much, everyone, for joining us, and tune in again next time. I'm going to end the event now, and we'll send across all the recording, the updates, and feel free to invest in the Vincent.
The Victor.
The Victor beforehand. So appreciate you all. Take care.
Thanks, everyone.